Good evening. Okay, so tonight we're going to be talking about life insurance largely. It's personal finance. Welcome. Let me get to the next line. Life insurance can be real complex or not so much. It doesn't need to be as complex as a lot of people make it out to be. For a lot of folks, and what I'll preach to you tonight is how to kind of keep it simple in terms of looking at what your life insurance needs are and buying the type of policy that gives you the protection you desire. So, define life insurance, define your life insurance needs, distinguish between the two types of life insurance companies, which is not a big deal. Select important provisions in life insurance contracts, which is, and then buy life insurance and recognize how annuities provide financial securities. Annuities, just in a nutshell, are kind of like life insurance, but the opposite edge. In terms of life insurance, you have to die to get the payment, whereas annuities, the only way you continue to get the payments are to continue living. So if you live longer, the annuity is a good deal. So anyway, we'll talk more about it as we go through. But define life insurance. So policies, companies promise to pay a lump sum at the time of the policyholder's death, sometimes while they're still alive. So, purpose of life insurance to protect someone who depends on you. So, this really is the way you need to look at it, and it makes things simpler. There's a lot of complex life insurance products out there that are usually, kind of hybrid life insurance. Investments, and those have been around for a long time. Whole life, universal life, all these titles that you're like, what? And you need somebody to kind of explain it to you, i.e., a salesman who's on commission, or you can just get like a term life insurance policy, which is just dead easy. You can figure it out. You can buy it from a conventional company, even somebody online. But again, you want it to be somebody reputable, so that they don't go out of business and affect the payoff ability. But anyway, life insurance can be easy in that way. But the big thing about life insurance is what you always want to be doing is you want to be assessing the situation if you happen to die. So the point is that you can't do anything about the person dying, but you don't want to give them additional headaches. The fact that you're gone and now they're stuck with huge amounts of bills. It's not supposed to be like they're winning the lottery or something. It's supposed to be an amount of money so that they continue their life, at least financially, as if you hadn't died. So it's a way to minimize the impact on the people you care about. Now, that being said, you can realize that the life insurance amount should be correspond to the amount of dependency others have upon you. So when your kids are young, they're very dependent upon you. They're, expecting you to basically fund their lives until they hit age 18, maybe somewhere longer than that. Now, if your kids are older and they've already got their family established, your house is paid off, you're getting older, and your needs for life insurance are probably, hopefully, non-existent. You should be able to basically self-insure at that point. You aren't leaving folks a bunch of debts, other than taking care of the funeral expenses and things like that. There's not a lot of money, a lot of expenditures, and so just the same, you're gonna be gone. But you, regardless of whether you have life insurance or not, you're not going to be leaving folks with a problem. So that's the way you ought to look at life insurance, and the fact that life insurance is something that people need when they're younger, when they have a lot of people dependent upon them. And not to get grisly about the whole thing, but there's these life insurance policies for babies. Take this life insurance. That is absolutely the death of a child. There's nothing more traumatic than that. But in terms of financial loss, it's kind of whatever, grisly, macabre, ghoulish, whatever. To think that you're going to end up with a $50,000 benefit when your baby dies. That's not life insurance. But from an actuarial perspective, if you're in the insurance business, yeah, you want to be writing insurance on little kids because the odds of them, they're like a new car. The odds of them breaking are quite low, whereas the older models they start to develop problems. Anyway, so that's the purpose of life insurance. So reasons, paying off a home mortgage. A lot of times too, the home mortgage thing is good, and it's obviously you don't want to leave folks with a mortgage, but don't be fooled again by the home mortgage companies when they offer a life insurance policy to you. They'll usually make that part of the mortgage. And are they concerned about you? They're concerned about their equity being protected. They don't want that home to, um, you know, go into default. So they want to make sure that you are that is paid off. To leave as part of your estate, it's always a good thing to leave on to your kids. But again, should you do that through life insurance, or should you do that through sort of a nest egg of investments? Because in terms of investments, let's say you're putting money towards a life insurance premium, or you're putting money into investments, the kids are going to be doing better in terms of an estate that's left to them an inheritance from your smart investments. Save money for retirement or income to education of children. Well, these are needs. Those are requirements of what that money will be used for the person. If you're married in this case, and there's your two income family, and all of a sudden you check out and you're down to a one income family, but you would like that your significant other to be protected, and then your children's education. Obviously, that's part of your responsibilities. But like I say, once those kids are done, graduated from school, that responsibility is taken care of. Medical expenses and funeral costs. It could happen this way, where you get some extended illness, and you're basically running your family in debt. And once you pass away, that death benefit from that life insurance policy is used to cover those medical expenses. But again, a nest egg or better medical insurance would be better, because there's if again, there's going to be some awkward ethical decisions if folks are, let's hope this guy dies pretty soon, because we need that life insurance policy to pay these medical bills. You don't want to put your kids in that sort of position. It would be better to have better medical expense or medical insurance, and not have the life insurance as part of that policy. Funeral costs, personal preference, yeah, but I could be buried pretty quickly. I mean, when you're gone, you're gone. But anyway, that's a personal decision. But elaborate funerals with big mausoleums, I'm not that kind of person. So some people are, and if you are, again, that's kind of a foul to be that kind of person and not have provided the money for that, to expect your kids to take care of that. Okay, principal life insurance. Mortality tables provide the odds of your dying based on your age and sex. So there are people, and this is when you fill out a life insurance policy, there's going to be a lot of questions. There's I've taken out policy. I was flying combat missions, and anyway, just before I went, I've been flying fighters, and this was in my younger days, and I did have a family, and so I boosted up my insurance just before I went away to fly those sorties. But anyway, in part of that, one of the insurance companies sent out a nurse, and they took blood samples and all this other stuff. They're gonna basically try and calculate when this person is most likely to die. Again, it's a nasty business for those folks, but there's people that are actuaries, and that's what they do. They calculate and decide whether you're a good investment for the insurance company, and how to price those premiums based upon your likelihood of dying. So, how long will you live? Premiums based on exactly projections for payouts of persons who die. So it's you get right down to it. It's a business, but it's a useful business. I'm not saying they're evil folks, but what they have to do is they have to make some pretty basic judgments based upon some not so nice factors. So, do you need insurance? Do you have people to protect financially? Do you have a partner who works? So these sorts of things, people you need to protect financially, and I kind of talked about that. If you've got a family, if you've got folks who are dependent on you financially, and not they used to be dependent, but they are right now, or they will be. Young children, especially, they need to be taken care of. And also, if you have a partner who's sort of a stay-at-home spouse, or whatever the situation is, you're going to kind of upend their lifestyle. I mean, you're going to upend their lifestyle anyway if you happen to die, but in terms of forcing them to go back to work, you might be able to prevent that if you had enough life insurance to, again, maintain some sense of normalcy and less traumatic change upon your passing. Determine your life insurance objectives. How much money do you want to leave your dependents should you die today? So there's some math that needs to be done. You need to calculate what it's going to cost, for your children's future expenses. Now, if you've got, say an able-bodied spouse and just out of pure boredom, they're probably going to go back to work, or they're going to go back to work once the kids are in school. You would calculate that out, but at the minimum, you'd want to give some sort of transition, some sort of buffer. How much will you be able to pay for your insurance program? Well, it depends what type of insurance you want, but again, like I'm going to advocate for, and most people who look at it from a financial standpoint will advocate for what they call term life. And term life is not very expensive. Term life is basically you buy insurance for a certain term, so say 10, 20 years in the future, and at the end of that 20 years, if you aren't dead, you get nothing. There's no residual value. It's just money that was paid, and it's kind of like auto insurance. If you don't crash the car, they don't give you money at the end. That's kind of how term life insurance is. There's no investment associated with it. Now, there's other products that are more complex that have an investment component, but the problem with that is they're not a great investment. They're more of a problem. Just 1 second. Yes.
I just wanted to let you know that I'm not going to be in class tonight.
Okay.
I fractured my foot.
Okay.
I got a hairline fracture right in there, so I'm on painkillers, and I'm just waiting for the wife to get out of class, and then she's taking us home so I can go to sleep.
Good luck, man.
Yeah. I know. Next week is the exam.
Yeah, I'll put all that out there. But if you can go to the Tuesday class, you'll be caught up. Otherwise, I'll send you
Is
the
there
slides.
Tuesday on?
Yeah.
Well, I got the slides off the blackboard.
Yeah.
For tonight. I don't know. I didn't see if there was a attendance question.
No. But I'll check that.
Okay. Yeah,
Good luck, man.
Yeah, I'm supposed to have a big interview this weekend with a CPA firm. It's like a 3-day long event. Not looking forward to it.
You'll be back up to speed. See you. So again, the life insurance objectives. How much will you be able to pay for the program? And again, if you're paying term life insurance, these are the ones you see on TV, and I'm not saying to buy from those folks. Find somebody reputable, a name that you recognize. Whatever. There's Ron Hancock, State Farm. There's Allstate. There's familiar names. That's what you're kind of looking for in terms of a company, and they'll have a variety of products. But what you're really looking for amongst their whole family of products are the term life insurance type stuff. And I'll go through the other products as well. But again, I can't really recommend those because they're probably not something useful for most folks. They have a couple calculations. Easy method, 70% of your salary for 7 years while your family adjusts. So, kind of a tough world here. We're going to give you 70%. The family's going to have to, within that point, figure out, you know, how to survive financially without you. I would think that you probably want a little something more than that, but let's say you're making $50,000, so 70%, we're talking like 35 times 7. So anyway, it's not going to be a tremendous amount of money. It's going to be a lump sum, but it's not necessarily going to pay off the house, take care of the college. Their lifestyle is going to be changed. Now, again, based upon the fact that life insurance is based upon what the requirements are, this next one, the dual income, no kids, well, you aren't really leaving behind a big mess. I mean, at least not financially. One half of the debts plus the funeral expenses, and that would cover it. Your spouse, obviously they're already working, and there may be other considerations, but in terms of minimum life insurance, one half of the debts plus the funeral expenses would kind of keep them at the status quo, except if you bought a house together, with 2 incomes, and now you're down to 1 income. So, like I say, most of the time for mortgages, the lender will insist on some sort of life insurance policy that's going to pay off that home in the event of your death. And again, they're not doing that because they're great people. They're doing that because they want to make sure that their loan doesn't go into default based upon somebody's death. The non-working spouse method, so number of years until your youngest child reaches 18, or multiply the number of years until your youngest child reaches 18 by 10,000. So, you got a 10-year-old, and youngest child reaches 18, so they're not going to get there till 8 years by 10,000, $80,000. Again, if you're buying term life and you're young, the policies are quite inexpensive. Now, term life, when you get old, when your propensity for dying is quite a bit higher on their actuarial tables, it's going to be very expensive. But the thing is, like I said, you should not find yourself in need of life insurance when you are older. You need medical insurance, but life insurance, unless you're somebody who's having kids in their 60s, you aren't leaving behind a lot of dependency. The family need method, more thorough than the first 3 because it also considers employer-provided insurance, Social Security benefits, and income and assets. Anyway, I would think any of these methods you're going to have to find something a little bit more complex, or just do some rough math. The house is this much. Is it covered by mortgage insurance? If it is, we don't have to worry about that. The kids, their college educations times whatever number of children we got. The living expenses, is the spouse working or not? But anyway, some of these quick calculations I think are just too abbreviated for a real decision. And I'm not saying a 2-day analysis. I'm saying a half an hour analysis as opposed to 10 seconds worth of a quick calculation. The 2 types of life insurance companies, analyze the various types. This part, I really don't care how the companies form. Stock life insurance companies are owned by the shareholders, 75% of this type. Non-participating policy. I'm more concerned with the overall structure, but the financial soundness of the company, whatever structure they want to form. How they want their company, whether they want to be a mutual life or a stock one. Not so important to me, but the strength of the company and whether I'm just saying that how the company is structured is not necessarily indicative of their being around to pay my policy in the event I die. So I would base decisions on that. I would base decisions on the financial strength of that company and their rating. There's objective outside agencies that rate the financial strength of companies, and that's more important than whether they're owned by the policyholders or stockholders. But anyway, if you hear a mutual life versus a stock life, that's all they're talking about. So term life. So I've already kind of given you a preview. Protection for a specified time. If you stop paying the premiums, coverage stops. Fair enough. Renewability. You can renew the policy without having a physical at the end of the term. So if you let it lapse, you may cause yourself problems if you're unhealthy. So, but this is kind of dead easy. You do this calculation initially to see how much insurance is required. A few years later, we've got one child in college now. We've got one child, maybe under scholarship. Well, we no longer have to, spend that money. We no longer have to have that much insurance coverage. And this isn't like, oh, that's money we got to blow on restaurants and trips and things like that. It should be that this is money that should go towards investments. So, money that goes into the insurance category should also be kind of characterized as money that goes into investments, because it's all concerned with strictly financial aspects. So, but anyway, term life insurance, there's not too much to explain. It's kind of dead easy, and it is exactly what it says it is. It's life insurance for a certain period of time. You start paying, the coverage starts. You stop paying, the coverage stops. There's no cash value to it, and you do your calculation. You say, look, I need $500,000 worth of life insurance. I'm a young guy, no health problems. You have to fill out all this questionnaire, all the policy details, and they say, okay, that's going to be $25 a month, and you're like, cool, and you're good, and then you've got the protection. There's there's no front loading. There's no commissions to be paid. It's just dead easy, and it's not. You can now use that money that you're saving with a simple life insurance policy. You can use that other money that you would have put in some more complex, more expensive life insurance policy, and you put that into some regular mutual fund, real estate investments, what have you, but an investment rather than a pseudo investment offered by an insurance company. Term life insurance company, or more of it, a multi-year, most popular form, and that's what I kind of talked about. Conversion option, if you decide to go with a whole life policy, which we'll talk about in a second. Decreasing term, premium stays the same, but the coverage decreases as you age. So term life insurance, as you get older, like I say, it's going to get more expensive. So it's only fair. Your chance of dying becomes more likely, so the rate goes up. Now you could also pay the same amount the entire time in terms of a premium, and just have the award, or whatever you want to call it, for the death benefit go down. Return of premium policy refunds every penny if you outlive the defined term. It doesn't happen that often. At least the policies I've got, and the ones that are inexpensive, they normally don't. It's like auto insurance. You don't get the money back at the end. Okay, whole life. So the name itself doesn't tell you a whole lot, or called straight life. That sounds like a lifestyle thing. Anyway, you pay the premium as long as you live. The amount of premium depends on your age when you start it. Provides death benefits and accumulates cash value. So the accumulation of the cash value is this, investment part. You can borrow against it, but look carefully at the rate of return your money earns. Well, if you do look carefully at it, you're going to realize that it's pretty expensive. So,
How's it going tonight?
I got to do a video thing. But Can I get with you in just a couple?
Sure.
Okay,
I'll come
I'll
back.
see
No
you.
problem.
Okay. Sorry for the interruption. So limited payment policy, pay premiums for a stipulated period of time, 20 to 30 years, or until you reach a specified age. So your policy becomes paid up when you're insured for life. So this is a variation of that same type of policy, but when you get enough cash in the policy, you no longer have to put any money towards it. But again, the amount of money that you're putting in there initially is, by a factor of 5 or 10 times as much as a term life policy. When I say a term life policy for a specific amount of coverage, may be as little as like $20, $50. One of these more complex things, they're viewed as an investment, and we're talking hundreds of dollars per month. Again, it depends on the coverage. Variable life, this is sort of an adjustment. Well, it is an adjustment to whole life policies to make them more financially competitive. So minimum death benefit, but death benefit can be greater than the minimum depending on the earnings of the dollars invested. So they're looking at sort of a market-based approach. Universal life is like this as well. There's universal life down at the bottom there. Adjustable life, whole life insurance policy, but you can change the policy as your needs change the premium payment. So again, a little bit more flexibility than what we had under that whole life. But all of these, the reason why I can't go into super detail on each type is because they're sort of the details are fuzzy because they're in the individual contracts. It's not like term life where it's kind of a straightforward proposition. I pay this amount of money. If I die, I get this amount. These whole lives, adjustable lives, they get to be much more complex, and you have to read the fine print, and you also have to buy it from a salesman. They'll be certified folks, and I'm not saying they're dishonest, but they're doing a blend of insurance and investment, and unfortunately the investment part, like they said in the previous slide, check your rate of return, and you may not be happy with it. Universal life, more direct control, pay the premiums at any time, increase in cash value of the policy reflects the interest earning on short-term investments. So they're getting your money that you have invested, and now they're sort of sharing their investment with you in terms of their rate of return. So it makes it more attractive financially because basically they're letting you take advantage of the market gains that they're making. In say a whole life policy, they're still investing this money in the markets, and they're making quite a bit off it, but they're paying you a small amount in return. In universal life, this is an evolution to try and make those policies more attractive so that you'll get involved. You'll stay with the program. So let's see, group life insurance. Group life insurance, it's not like these others. It's just the format of how the life insurance is sold. Group life insurance is typically from your employer, like they say. No physicals required. It's often subsidized by the employer, and it's just a term insurance. It's with you typically while you're with that firm. So it's it should be individual life insurance policies that you get on your own, and then group life insurance would be the insurance that comes with the company you work with. But again, in a cafeteria style format, you can also opt out of that policy, and again, that money will be not deducted from your income. Is that a good idea? Depends on the subsidization, how much they're going to subsidize that insurance. If it's heavily subsidized, you may want to stick with it and have redundant insurance. But typically, well, anyway, you'll have to look at it. Next, endowment life insurance. So, covers from beginning of contract to maturity, specified sum to the insurer. So this is even more of a investment. It's it's just you're paying money into a fund, and it's just a guaranteed payment, like they say. So the real problem with life insurance that goes above term insurance is that it's a blending of insurance and investment, and if you read up on it and you talk to different folks from the investing perspective, you'll find that the insurance provided by these companies is not bad, but their rate of return is just not competitive with other folks out there. Credit life insurance. Sorry. Credit life insurance. Again, these are mainly to protect the creditor. Debts, they pay off when you die, protects the lenders, and it's usually expensive protection. Now, it depends on how it's structured. If it's offered by the in the terms of the mortgage, it may not necessarily be that expensive. But if it's extra insurance that's sold to you as an optional product, it probably is quite expensive, because again, there's it's one of those things like if the cars, if you buy your floor mats from the dealer, they're probably the most expensive floor mats out there because everybody's getting a cut off it. But if it's something on a mortgage type policy, I haven't found those to be too terribly expensive. It has more to do with those folks just wanting to protect their interest rather than trying to make a commission off of you. Important provisions in the life insurance contract. So, naming your beneficiary, and contingent beneficiaries. So these are going to be people who are going to get that, payment. Again, you want to make this less confusing, as least confusing as possible, and you also want to make sure that people know that they're a beneficiary, so they know where to look and if it's kept in a safe or where these policies are held. If you do happen to go in one of these situations where you have a late payment, a lot of times it's just a change of address and they don't send you the bill or it goes to the wrong address. And if you go into some lapsed payment, you may have a problem where you may not have insurance in force, or if they want to reestablish it, they want to reestablish it with new terms, which may require you to have another physical and be medically, reevaluated, the rest of that. Non-forfeiture, keep the benefits if you drop the policy. So again, one more reason. Let's say you have a whole life policy and you lose your job and you can no longer make that payment. What do you stand to lose? With a term life insurance policy, you'll probably still be able to fork out that $50 or whatever it is to keep your life insurance going. But if it's a more complex insurance policy with an investment part of it, and you're talking a $200 or $500 a month type payment, you may not be able to keep it, and that'd be another downside. Contestability policy. After you've had the policy for 2 years, they normally can't dispute it. So you have to be upfront with these folks. If you say, no, I don't have diabetes, and you do, and things like that, and you die 6 months into the policy, you can bet that insurance company is going to fight not to pay that claim. But after 2 years, they're saying that stuff is all a wash. The same thing with suicide. Other things, automated premiums. So accumulate cash to pay the premium if you do not pay in the grace period. Doesn't apply to term life insurance. Misstatement of age provision. If if you lie again. Policy, borrow against the cash value, waiver, premium disability, accidental death, guaranteed insurability. So anyway, this is all sort of the small print, but the double indemnity is again, it depends how you happen to die. But if it's not from natural causes, if it's an accidental death, it is common to have a double indemnity, which would be twice the value. So there's movies about it. People trying to fake their deaths or whatever to get more money. Cost of living protection, again, the amount of money can be decreased by inflation, so that's a good thing. Accelerated benefits, living benefits to pay for the terminally ill before they die. Again, kind of a grisly sort of scene, but sometimes there's some costs that are involved, and to be able to get that money before is beneficial. Second to die, so when they have two people who are insured, it may not pay off until the second person passes away. So who do you buy from? Like I said, they should be companies that you're familiar with. AM Best is one of the companies that I talked about in terms of a private insurance company that will, well, not insurance company, a private rating company that will rate the health of these insurance companies. And the insurance companies are rated largely by their portfolios. If they're involved in a lot of risky, because they're getting your money and they're investing in it, and that's kind of the game they're playing, is that they can make quite a bit of money off of the money before they have to give it back to you upon your death. Friends and colleagues, sometimes. Rating the insurance companies, again, Standard & Poor's. So the company ratings, the AM Best, Standard & Poor's, again, is just going to be strictly the financial business for rating any company. Insurance agents. A lot of times, for the term life stuff, you may not even need an agent, or it may be the same agent that you have your automobile policy with if it's a full line type company. So, but they're talking about find a policy that's right for you, this person. If you ask a life insurance policy or salesman, you're kind of asking them a loaded question, because do you want the one that doesn't pay you any commission, or do you want this one that pays me a huge commission? I mean, you can kind of figure the answer you can get back from the folks. And they've probably got, some whatever. They've been coached and persuaded that maybe the whole life policy is the best. But I don't think they would make that same recommendation if they were looking at strictly on financial terms from your perspective. Are they asking about your financial plan? Do you feel pressure? If you put yourself, anyway, if you get pressured by a salesman, financially it's going to be a tough life for you, because you can't be pressured by those folks. And if you do feel pressured, again, that's probably the time to step back. For life insurance, for investments, for all that stuff, if you can find a person who is independent, who doesn't work on commission but works for a fee, so you're going to have to pay him like you would pay a lawyer. You pay a lawyer, I guess, about $250 an hour, and maybe for your financial advisor you pay them $250 an hour. But now they've got a fiduciary, trust with them. They don't have there's no money to be gained by getting you to buy some high commission whatever. There's no money to be gained by them having you trade stocks within your portfolio to generate a bunch of commissions. They're just looking at it strictly, you're just hiring somebody who's got expertise, and they're working, fee for services type basis. Because people who claim to be, basically giving you a free deal, and they're on commission, it's not free at all. They've got an interest that may not be aligned with your best interest. So, if you can find an independent financial advisor who just works on a fee for services, unless you choose to really explore it yourself, and you can do that quite well. And then you should also do that to a certain extent so that you can have a more educated conversation with that financial advisor. So you ask kind of the right questions, and you get the come to the right conclusions. So comparing policy cost. So compare policy costs, which are affected by how selective whom they insure. If they're going to give you a policy without any sort of physical, you got to look at it from the perspective of, well, that's good for me, but what about if these guys are insuring people who've got chronic conditions that are halfway? I mean, they aren't going to be able to offer me as low of policy, premium, as if they did a rigorous inspection of their potential folks. So again, if you're in good health, you may want to look to the company that is going to do some sort of thorough medical evaluation. Their cost of doing business, return on investments, mortality rate, policy features, and competition. So there are going to be some factors that are going to change the rates, but the actuarial data is pretty accurate, and the numbers amongst the different policies are not going to vary that drastically typically. Again, if you're buying something on the telephone or over some TV ad you saw, or some internet thing that you didn't actually seek out, you're probably going to end up with a problem. But if you're using AM Best and you're using Standard & Poor's, and these are companies that are kind of household names, you're probably going to do just fine. Use an interest-adjusted index to compare policies, time value of money, all this other. I don't do that because I don't buy those types of policies. I keep my investments here and my term life insurance, policy there, and that way, when I need to make adjustments based upon where I am in my life in terms of term life, I do that. In the investments, that's a separate item. So if you do look at the time value of money and you do invest in insurance as an investment, you're not going to be happy with the rate of return. Obtaining a policy, not hard. Contact the company. Like I say, most of them will want a medical history, but again, that's not a bad thing, especially if you're in good health. Group policy or work policy, yeah, they typically subsidize, and they don't have a physical. Read every word of the contract. You can try, and you should, but the understanding of it, if it's a real complex policy with a lot of different, it may be just too complex. Again, term life normally doesn't have that complex of policy. There's certain statutory, 10 days to change your mind, and make sure you let folks know where the insurance policy is, and your lawyer. Anyway, that assumes that you have like a lawyer in standby, which most folks don't. It's more up to the beneficiaries and the fact that you don't necessarily hide the policy. Settlement options, lump sum, limited installment, life income, proceeds left with the company. Most of the policies I've bought have never really allowed me that. It's kind of a take it or leave it deal. And usually with the term policies, it's a lump sum. So again, depends how good the people are that you're leaving the money with. You know how the lottery works out, how most of those people end up, dirt poor after about 5 years. Hopefully your beneficiary will be a little smarter. Switching policies, you can do that. The older you are, the higher the premium will be. Are you still insurable? Can you get all the provisions you want? Again, with term life, it's not a big deal. Your term life, the policy will go up as you get older, so there's not a whole lot of changes. You can switch between companies, not a big deal. But if you're into the whole life type policies, universal life, it's more complex because now you're switching investments. How annuities provide financial security. Again, like I said, annuities are a good deal. It's a certain, you put forward a certain amount of money and they pay you, let's say they pay you $100 a month from that day or that month forward. Every month they give you $100, and if you only live 2 more months, ooh, bad deal. You got $200 for your $10,000 you put down. But if you live 40, 50 years more, you get $100 a month for 40 or 50 years. So these are kind of nice in terms of a little bit more positive subject. The longer you live, the more money you get, which is nice. Life insurance, the only way to collect is to die. People buy annuities to supplement retirement. There's certain provisions of the Health Care Act that treat them more like typical investments, and those who expect to live longer than average benefit the most. So again, if you're in good health and you expect to be, annuity might be part of your investment portfolio, and it is going to provide that guaranteed income. Inflation adjusted? No. So $100 a month now is something you could do something with. $100 a month 20 years from now may not be worth much at all. So that's what annuities are. Life insurance, like I said, that's the end of the slides. Life insurance can be pretty complex, but it doesn't need to be. Again, for most folks, and I'm not alone on this. I mean, you can listen to whatever financial experts you'd like, and if they're financial folks, not life insurance folks, almost to a man, they'll request or recommend term life insurance, just because it's easier to calculate, easier to change, and you can get exactly what you need and change it as you go along through your life. And like I say, if you're getting older, your need for life insurance should be greatly reduced based upon the fact that you don't have as much dependency upon you at that point. All right, sounds good. See you next week.